Hey everyone, Jonathan Gorenstein here with a very special guest on the Industrial Insider. I have Max Vo from NYX Capital. Max is specializing in valuation, financing, developing, and disposition of properties. He has more than 18 years of experience over his career. He's invested on behalf of large institutions from BCI, AIMCO, HOOPP, Greystone, PSP, and the list goes on and on. I'll have Max kind of give us a little bit more insight on some of those transactions, and we'll go from there. Max, thanks for joining me. Appreciate the time. Why don't we jump right into it? What is NYX Capital?
So thanks, Jonathan, and thanks for doing this podcast because I've watched other episodes and I think it's a fantastic venue to reach out to our peers in the commercial real estate industry as well as potential customers. And so far, you're doing a great job. So I just want to start off with that. But I'm doing great. And yeah, so let me just jump into it. What is NYX Capital? As you mentioned, Jonathan, like you, I started off in the industry about, coming up on 19 years now as a commercial real estate agent, right?
No way.
And so I'm still licensed to this day. I still have my license because I never want to take those courses again. Yeah. But anyway, my quick background, and I'll kind of build up as to how, we got to NYX Capital, which is a private equity real estate investment development company.
Right.
But my background really started as a commercial broker for 3 years. And after doing commercial brokerage for a while, unlike you, I decided that I wanted to just understand, more the mindset of the owner, right? And I wanted to know, like, how do these people make money as opposed to, the brokerage side of the business? So I was fortunate enough to have opportunities to work for some of Canada's largest, I would say, asset managers and portfolio managers, including GWO Realty Advisors, where I specialized mostly in industrial properties, but touched on some retail as well. I worked for Morgar Investments for nearly 7 years, where I manage a portfolio of nearly $1 billion across Canada, mostly on behalf of, as you mentioned, pension plans, because pension plans, they love stable, predictable returns. And as we are all industrial experts here, we know that industrial's been a fantastic, stable, predictable, and very prosperous segment to be invested in. And that being said, though, after jumping from, large pension plan sort of investment side, I got to the point in my career, John, where I wanted to be a little bit more entrepreneurial. And I went back to school, did my graduate degree. And at school, I met my current partner. And my current partner, his family, they're a high net worth family, and they were mostly invested in residential, right? So we teamed up and said, let's create a private equity company where, yes, we're going to continue to focus on residential development opportunities, but I wanted to bring in what I thought were fantastic commercial investment opportunities. And so what is NYX Capital? Once again, we're a private equity investment development firm. And what we do is that we're not very large. We're about 20 people here in Toronto. And we try to play this fine line, right? Where we pick projects that are probably a bit too big for private investors or high net worth investors to invest in. But I also pick projects that are too small for institutional investors. So most institutional investors, it doesn't matter if you do a $10 million deal or a $50 million deal. The work is the same. And I knew that because I used to sit in that seat. So we pick projects. Our sweet spot is right there. We'll look at projects as small as 5 million, typically up to $50 million. And we play in that snack bracket where we can, A, push out the private investors and push out the institutional investors, but B, we pick projects where you need to roll up your sleeves. So typically on a private equity real estate deal, I'm able to offer my investors usually net of in excess of 15% a year, sometimes in excess of 20% per year, net of all of our fees. So once again, take out the private investors, take out the institutional investors. We play in the area where we got to use our expertise, roll up the sleeves, and create value so that I can make my investors happy.
Can you give us an example of a deal that institutions wouldn't look at, private guys wouldn't look at, and that's kind of your sweet spot? Is there a deal recently that you can share and give our listeners a little bit of insight of start to finish on that type of transaction?
Yeah. So we participate in a couple different areas. We're actually asset class agnostic, right? So when we look at deals, once again, I've got this criteria where I want to give my investors at least 15% per year. So what does that mean? How do you get that? You can't do it without taking some risk, right?
Right.
So typically, the areas we find we can create the most value is A, through land development. So
Right.
take a piece of land, find the highest and best use, roll up the sleeves, figure out what the environmental problems are, eliminate those risks, and then have a piece of land that can now go to a developer or another investor with a lot of the problems taken away,
Right.
right? And I'll give you one example of that. So we bought 2 acres up in Richmond Hill on Yonge Street. It was a 2-acre site with some leases and with some environmental work. And we looked at that site and said, well, it really should be a condo. We
Right.
bought it for $15 million. So, right in our sweet spot, right? $15 million. We typically lever our projects about 70%. So that means that 30% we need is equity. And we'll go around to friends and family, or if it's a bigger deal, we can go to institutional investors as well. And exactly 24 months after purchasing that property, we flipped it for 25. Now,
Wow.
how did we get there though, right? So just you can kind of do the math a little bit, right? Let's say we use like 35% as the down payment, right? So it was a $15 million deal. So we needed about $5 million, right? And then you bought it for 15. So I had $10 million mortgage, sold it for 25 2 years later. So rough math, you kind of like tripled your money. So if you would have invested 5, I would have given you a check for 15 at the end of the day. So that's well in excess of my typical 15% that I would give to an investor, but that's just one quick example. And how did we get there though? So we took on the risk that a lot of developers don't want to take. We're buying a piece of land that doesn't really have any income. It has risk. We don't know what is the maximum density that we can get, but that's the type of project that our investor is willing to invest in. I'll give you another quick example. We bought an industrial building in Mississauga. So that was residential. Now over the commercial side, industrial building. 15-acre site, has a 200,000 square foot building on it with rent. We bought it for $21 million and change. Once again, we put financing on the building. Financing was $15 million. So we threw in, $6-7 million because we needed a little bit extra cash to get the improvements done. Fast forward, it's been 2.5 years since we bought that building. We've now done some environmental work and we've improved the rental rates on the property. And on a $21 million purchase, we just got it reappraised at $45 million, right? So once again, after all our fees and whatnot, it's a 3-banger, right? Give me $100,000, I can write you a check today for $300,000, 2.5 years later. So just 2 examples of the things that we do.
Okay, so let's go back to, I think that's a great example of what you did in Mississauga. You mentioned that you did put debt on it and it had environmental issues.
Mm-hmm.
I don't want you to give away all your secrets because I know you got a couple underneath that you don't want to share, but how'd you manage to get debt on a site that was contaminated?
So their lenders are willing to work with you, right? So if there's contamination, basically you need to be progressive. You need to be upfront about what those issues are, and you need to work with consultants. And I think that you've had some good environmental consultants, one of which that we use, Pinchin, right, who work closely with us to try to figure out what the issues are up front. And then that's the thing. Before you buy a property, you got to make sure that you do your diligence. And in your diligence, like for me, the things that I really focus on are the use. Like if you're going to try to get your highest and best use, you better make sure that the zoning is there for you to get there. And if not, if you're going to fight the zoning, make sure you have an idea with planners, with professional planning staff, to, not only in-house, we use external planners, and we work very closely with the city to make sure the zoning's there. That's number one. Number 2, environmental. Can you manage the environmental, and what is your plan? And you definitely need outside help to get there, right? But then especially on the funding side, if you can figure out the first 2 things, you can then pitch the story to the bank, to the lenders, and make sure that you have a plan going forward. And if they can wrap their heads around what your plan is and what the budget is, typically you're able to find financing. That being said, though, like a lot of people may be listening and wondering, well, private equity real estate, it sounds like great. Like, why isn't everybody doing it?
Right.
Well, I'll tell you that the challenge for especially private individuals, and that's why instead of doing it on their own, they'll just team up with us and do it together with us, right? It's because you've got to take some risk, and sometimes we have to put personal guarantees on some of these loans, and not everybody's willing to do that. On the institutional side, when I was working for the larger pension plans, we typically took non-recourse debt. And when you take non-recourse debt, it's great because you're not, personally guaranteeing anything. You're not even guaranteeing, any companies that you're working with, but it means that you get lower loan to value. You might only get 50% financing. And for us, we do use debt and leverage to juice our returns. And so we're typically 65 to 70%. So we take on a little bit more risk to do that. But yeah, for sure, private equity real estate debt is a big issue, and without it, you can't get deals done. So we obviously heavily focus on that at the get-go.
What do you see as good value right now as investments? Like, you're obviously exposed to a lot of deals. Is there a particular area that you see that there's a ton of value in from the private equity side?
Yeah, so on the private equity side, it's once again, it's really interesting, right? So in order for us to consistently pitch and look at new deals and provide good returns to our investors, what we found that it's actually not that easy to try to consistently give investors 15 to 20% on a real estate deal, right? On a typical real estate deal, you're usually in the single digits somewhere, right? Look at cap rates, and that's where you are. So how do we get there? So one area where we've decided to, kind of branch out a little bit is that we're not afraid to get involved on deals where there's an operating component as well. Case in point, our project on Dixie Road in Mississauga, for example, that industrial building, yes, we own the land, yes, we own the building, but then we decided to partner with our tenant. He was an executive producer working on behalf of ABC and Disney at the time, and said to him, why don't we become our own tenant in the building? Let's become a film studio, and let's write, a lease in this property. And in addition to getting rent, now we are able to arbitrage and take a little bit more rent as working as a film studio. That's number one. Number two, I've been watching over the past, I would say 5 years of my career, watching these guys working in the self-storage industry come and pick off industrial buildings at prices that I couldn't understand.
Right.
And I decided about 3 years ago to do a little bit more research and try to figure out, why, how could they afford to pay these prices? And it actually wasn't that hard because I could literally go onto their websites and figure out what rents they were charging. Right. And then when I was watching self-storage companies, which are for the most part, they're kind of like, industrial like buildings, commercial buildings, and they were charging rents in excess of $25 or $30 gross compared to my industrial rents at the time, which were like $5 or $6. And even in excess of, say, suburban office rents, net rents, which are like, $15. I'm like, how are these storage guys doing it? And once I learned that the rents were, closer to $30 gross, I said, opportunity. So we are in the self-storage business now. We're up to 8 properties, and we have another 4 under contract right now. And we're looking to grow, 5 to 6 buildings a year is our plan. It's because we're willing to develop the properties, convert buildings, go into existing buildings, but have that operational, that operational key to it to provide my investors 15 to 18%. So 2 examples. We're in the film studio business. We're also in the self-storage business, which is real estate, but it has an operating twist to it as well.
So it sounds like real estate was essentially a segue into all these other businesses. Like, you've taken a different approach while just looking at the real estate. You're looking at the broader picture. For example, self-storage or the film studio. Like, you're really trying to figure out the whole pie rather than just one slice.
Yeah, exactly, right? Because if you take a bird's eye view and you say, if we can make the pie bigger, then that's how I can, give my investors more return, right? Yes, we're taking a little bit more risk. We get it. But our team, we're really strong investment and real estate development professionals. And obviously, we cannot do this with like fantastic partners on the other side, on the operational side, whether it be the film studio business, whether it be self-storage, and we're also in the fitness industry, right? So we decide to, do what we're good at, which is build buildings, find properties, develop and manage, and then have really, really excellent operational partners to execute the business in the buildings that we develop.
All right, so let's move on to, as a broker, what kind of deals would you like to see from brokers bringing to you? Like, what kind of things you want to see come across your desk to really transact on? Or does it just go back to the $5 to $25 million range? Everything, nothing that institutions would look at. Like, Is there a simple answer or no?
Yeah, I think for us, when I'm working with excellent brokers such as yourself, and so as a broker, you know what questions to ask me, and you ask me what my investment criteria are and what I'm currently doing. And by watching my transactions, you've got a good idea of what I'm up to. But I would say that this may sound a little bit ironic, but I'm looking for problems,
Right.
right? Bring me problems, because I have the team who's willing to roll up their sleeves and solve them to create that value. So unfortunately, I'm not looking for, projects like in my past life when I was working for pension plans, looking for steady, predictable return. So give me 5 to 6-7%, and that is very fantastic, because it meets a certain need. No, I need that higher return, and the only way that I can get that higher return is by taking on a little bit more risk. And what does that mean? It means there's got to be some problems for us to solve. So, so basically, I'm looking for problems. I'm looking for trouble. That's what I'm looking for.
So if you have trouble, bring it to Max.
Yes, I'll take a look and I'll try to figure it out.
Let's go a little bit bigger scale. I guess the big buzzword right now is inflation. What's your take on the economy in general? Like, where do you think things are going? This is kind of my last questions to sign off. Like, do you think we're heading for a downturn? Do you think rates are going to continue to stay where they are? Do you think real estate values are going to drop? Like, what's your general opinion of what's going on in a broader view, looking at the whole pie?
Yeah, I would just say from a very macro perspective, right? I think we all have concerns about inflation, right? We're seeing record low interest rates, which is really feeling not only what a personal consumer can purchase a house for or get a mortgage for, but we're seeing it across the commercial real estate industry, and we're seeing it across construction prices, right? Quite frankly, I was bidding. We usually do fixed price contracts when we do new developments, and just 6 months ago, building one building to the same building today, those prices have gone up 20 to 25% on the hard costs. Like, that is nuts. You typically budget like 3 to 5%, not 20 or 25%. Inflation's a problem, right? Without a doubt. And how do you curb inflation? Well, you can increase interest rates, but you start increasing interest rates right now, what's going to happen to the market? So that's a concern. But that being said, though, stepping back for a second, right? Like, take a look from like a pension fund's perspective, which I have a little bit of experience, advising them and working with them as an advisor, or portfolio manager. When I first started in the business, right, it's almost 20 years ago, pension plans typically would invest between 1 to 3% of their entire portfolio in real estate. And that number now, if you look at some of Canada's largest pension plans, you can look at their annual reports and look at their real estate holdings. That number, it's not uncommon to be around 10%. Some of them are close to 20%. So that means that the large institutional investors in Canada have literally increased their real estate investments, in some cases tenfold, in some cases, almost 15 times what they used to allocate. Now, why is that? 2 reasons. And I know I'll get to the inflation part, okay? Why do they like real estate? Why should we all love real estate, as a matter of fact, okay? This is why. Because number one, it is a great inflation hedge, okay? What do I mean by that? Why is it an inflation hedge? Well, first of all, real estate, as we know, we buy real estate because it has income. Tenants pay rent. That rent can be used to pay pensioners, and it's great for cash, it's great for investment. So cash is amazing, and it comes from real estate. Number two, real estate provides capital return. So obviously, in addition to the rents that you're achieving, you're also getting some capital appreciation. So the value in addition to the cash. Now, the secret sauce to all this, though, is really the inflation hedge. What do I mean by that? Well, when you have a large portfolio of real estate and you have lots of tenants, guess what? Those tenants roll, okay? And as those tenants roll, what happens? You increase rents. If they have inflation, prices have gone up, guess what? Those rents have gone up too. So if I'm an owner of a large portfolio of real estate, do I care what happens to inflation? Of course I do, because interest rates, it affects us. But unlike maybe other businesses, I've got a natural inflation hedge, because as I roll those rents, guess what? I'm in line with inflation. Right. So that's why real estate is such an amazing business when you think about it. But obviously there's pitfalls, right? Don't get me wrong. If you're an owner of a 200,000 square foot industrial building and you have one tenant, that tenant leaves, you know what? It's not such a great hedge, right? But if you have a large portfolio of $1 billion, doesn't matter as much. In self-storage, I have a building that's 150,000 square feet, and guess what? I have 1,000 tenants. So even with inflation, it's not likely that I'm going to have 100 or 200 tenants roll on me. It just doesn't happen, right? And every month I can increase those rents, and I'm just hedged perfectly with inflation. So yes, I'm worried about inflation, John. I am. But being in our industry where we collect rents that can be marked to market on a regular basis, it's a nice place to be.
So in general, you're not slowing down. You're not going to sit on the sidelines and see what happens. You're just going to continue to do your thing, develop, and just ride this whole thing out.
Yeah, we are, and we're just very fortunate. I mean, there are some of my peers in different industries or real estate segments that have been hurt. Like it's not a secret. The people who have big portfolios of retail right now are hurt because their tenants literally are not allowed to open. And when they're not allowed to open, how can they pay rent? Right? Taxes are still there. Operating costs are still there. Snow removal, window cleaning, you still have to do it, but the tenants can't operate, can't pay rent. So it's just very fortunate. We happen to not have any significant investments in retail real estate. We just happen to pick other areas. So in the areas that we work in, which are, self-storage as well as industrial, right? We're doing okay, but certainly it's hurt other segments of our business, right? But we think it's going to come around. Hopefully we all get out of this pandemic, right? And we can all move forward.
Yeah. Well, everything is pointing positive these days, especially with the low infection rates, and vaccinations are going up, and everything else is going along with it. Max, I wanted to say thank you for joining me on the Industrial Insider. If you have any questions, reach out to myself or Max. My email is jonathan@leonard.com, or give me a call at 416-471-0904. And thanks again for joining me on the Industrial Insider. Thank you, Max.
Thank you for having me here, Jonathan. Have a good day.
My pleasure.